I'm Ashton Addison from EventChain for Investmentpitch Media and FinTech News Network. And today on Blockchain Interviews, we have Steven Van Metre, macro money manager and the inventor of Portfolio Shield. Steven, welcome to the show and thanks for taking the time to be here.
Hi, Ashton. Thanks for having me.
You're very welcome. Before we dive into the markets, I'd love for you to just give a little bit on your background on yourself and your recent focuses and investing philosophy.
Sure. I'm a certified financial planner. I'm also a money manager. And the way I approach the markets is on a very long-term scale. So when I say I'm a manager or I'm interested in macro, my time horizon is 3 to 5 years when I'm looking at taking a position. And that's very long, considering I like to say that most investors today have investment. I forget what I was going to say. Anyways, it's like ADD, investment with investments.
Yeah. Okay, so the I know what you mean, because right now the stock markets have been really hot and it gets people, retail investors and dumb money jumping in with, little goggles on that just have them looking at the next day, right? And when you're a macro money manager, it's a whole nother story, right? You're looking at the long-term trends. And right now, there are a lot of people jumping into the stock markets. With the lockdowns, people sitting at home and looking for other ways to make money, the stock markets have been really exciting. But I know that, you're considered the bond king and you focus on bonds a lot as well. And that's actually a really important part of managing the economy. So could you talk a little bit about, why are bonds so important? And I know people aren't talking about them because they're not as exciting, but I think it's a really crucial point to get across.
Right, because the bonds are macro. And so if you want to know what's going on in the economy, you look to the bond market. It tells you the truth. I look at the equity market and, it's very enthusiastic about lots of things. And the bond market, again, it's a sayer of truth. So do you want the economy is growing? Well, the bond market should tell you that when interest rates are rising. Is the economy doing poorly? Well, then interest rates should, or even falling. And you can even use it, as an arbiter of truth for, say post-March. Everyone thought that stimulus and quantitative easing were going to be inflationary. Well, the bond market gives you that answer. So it's not as sexy and as exciting as certainly, the latest tech stock, but it does tell you a lot of truths.
Definitely. And, you mentioned that you have 3 to 5 year time horizons, and a lot of these Robinhood traders that have jumped in, they haven't even looked at the market for a year. But the market has definitely changed since last year, or at least it seems so. Would you agree with that? And did you see through the bond market changes in the market happening, before March of 2020?
Not so much. You see a lot of speculation in the equity market. A lot of small traders are using call options to trade, and they don't understand the risks of that because you mentioned they haven't been investing long enough to know. And the bond market really kind of has shrugged a lot of that off and as noise, and it's kind of been more of an alarm to say, hey, yeah, the equity market's enthusiastic, but hang tight. I'm telling you, it's not as great as you might think. And then that's where we look at it again for a little bit of truth.
And would you recommend people that are invested in the stock market or even that are doing swing trading and have just jumped in to open their ears to the bond market and see, the correlation and how that's determining the actual economy?
Well, I think it's important as an investor to do it. As a swing trader, as a day trader, it really doesn't matter. I look at the bond market as more of what our lives are like. We live in a macro world. For some reason, you put a trade screen in front of people, and macro becomes, like you said, 2 weeks long. We don't live a life like that where we're constantly making trades and changes. So you can look at these short-term investors, and maybe over the course they'll have a lot to say about it. Maybe they'll have made some money, but in the end, it's those who take that longer focus, specialize on their research, and are willing to wait and go through those undulations that usually get the biggest payoff.
Yeah, I think that's really great advice. And to just go back to the stock market, the story of 2020 of the stock market it's a little crazy, crash, V-shaped recovery on the way to the election. Seems like we're above all-time highs, even though the economy isn't really equating to the markets. What's your take on the markets right now, they continue to go up. It doesn't look like there's any crashing, but they're also have been pushed up by debt and stimulus. Do you think people should be approaching this cautiously, or are you still optimistic that the trend is your friend?
Well, I mean, the trend is your friend, and unfortunately, the U.S. equity market does not function on reality. It's a large momentum trade. We see that with all the computer algorithms. We see that with all the computerized trading strategies. And I'm not talking about small strategies. I'm talking about large insurance companies and large money managers are using computer traded programs that just look at trend following. So what you've seen is this year, especially since the pandemic, as you mentioned earlier, people are at home and they have this belief that stimulus is stimulative. They have the belief that QE creates inflation. Worse, they believe that quantitative easing actually causes asset prices to magically rise for some reason. And so they're just taking incredible amounts of risk with their money, thinking they can't lose. And that's always a dangerous proposition. When the moment you think you can't lose, well, be careful, because the other side of the shoe is about to come.
Definitely, Steven. And Dave Portnoy says it best with his billion followers on Twitter, most of who have just jumped in based on the hype that stonks only go up, right? And he had actually jumped into the blockchain industry and invested in Bitcoin, but the next day that he invested, it went down. And that wasn't, that didn't make sense in his mind, because he's been making so much in the stock market this year as it seems to only be going up. He jumped out, and Bitcoin went down after he sold, but now it's above where he sold, if he would have had that foresight. But, for these other people that are following traders like Davey Day Trader and they're just looking at stocks on Twitter, I'm guessing that, you would say take a step back and sort of look at the macro trends and don't base trading off emotion and what other traders are just posting on social media. Would you agree?
Well, I would say the trading is just that. I mean, people that trade, they have this need to move their positions around constantly. What I like to think is when you start investing, the best thing that can happen to you is to lose money right away. The sooner you lose money and the more you lose, the better off you'll be. And I think what's going to happen, even though I believe we are in a recession, although the stock market certainly wouldn't indicate that, but at some point, the economy will continue to head lower. The stock market will figure that out. And there's going to be a substantial loss taken by a lot of small people. And rather than a positive experience where they go, hey, you know what, I made some mistakes, I could have learned from this, it's going to sting so bad that it might them from coming back to the market for a while. And we saw that with real estate after the great financial crisis. We even saw it with stocks after the great financial crisis. So yeah, all this day trading to me is not the best way to approach it. I think people should have a small portion if they want to trade of their money, that they should do that. And then they should look at the macro picture and then trade the bulk of their, or I shouldn't say trade, invest most of their money with a long-term focus and let it ride.
That's great. And we talked about the Fed. They've been printing. There's been QE. The interest rates are low, and the Fed has announced that they're going to keep them low. At first it was 2022, and now it's 2026, and who knows, it could be forever. What do you think of these low interest rates, and who will be impacted the most in America from this?
Well, the first misconception is, as you probably know, is the Fed isn't actually printing money. That is a big misconception. All the Fed is doing is a reserve swap with the large commercial banks, swapping treasury securities and mortgage-backed securities for a reserve asset at the Fed. While it sounds like money printing and everyone wants to believe it's money printing, no actual new money is created. But as far as who's going to be hurt by low interest rates the most, well, initially it's going to be the baby boomers that are in or at or near retirement, because they're now they have been forced to actually take risk in the equity market, which isn't the best place to be. As you get older, you want to move more into fixed income. The problem is there's not a lot of yield there, so they've had to go to corporate and high yield bonds, which generally don't perform well during recessions. As far as everyone else, was that, hey, if you're a Gen Xer or a millennial, this is going to be great because you're going to be able to borrow at low interest rates. Well, one of the problems with that is that low interest rates also lead to a weak economy and fewer jobs. So at the onset, younger people are going to think this is great. As they get older and find out that the labor market isn't that conducive to new jobs, it's going to be a lot harder than they think, and they won't know that it's being caused by low interest rates.
Yeah, and seems like such a major shift going on right now, especially with this technological revolution, the acceleration of AI and technology through the pandemic as well. And I think that the labor market and the job markets is going to shift dramatically, and in the next 10 years, it will look a lot different. So that's super interesting. And I was also looking at your recent content, and one thing that just came out was the International Monetary Fund. The IMF is talking about a Bretton Woods moment. Bretton Woods, 1944, is pretty much over 75 years ago now, when they were talking about recreating a new world dollar that was backed by gold. And although they didn't mention anything in there about creating a new dollar or changing anything, they just said it was a moment, and it seemed interesting that they would put that out. What was your take on the IMF's message, and do you see in the near future, because of the acceleration of the pandemic, a central bank digital currency with or without potential blockchain technology as well being released soon?
Yeah, I thought the whole speech about the Bretton Woods moment was really blown out of proportion. And you put Bretton Woods in front of anything, and I think people stop listening to whatever is following that. And perhaps it was a poor choice by the IMF to use that as an example. But if you actually read the speech, which isn't a really long one, all they talk about is the need for the world to come together and use their fiscal and monetary policies as a cohesive group, with certain countries in certain areas needing more or less than others. They also talked about the money needing to go actually to the people, which that seems pretty logical place where it should go. And then they kind of ended with saying, well, what we're going to do is loan more money to emerging markets, which tells us kind of something we've been very suspicious about, and largely know for a fact that there is a global dollar shortage out there. And who would need those dollars? Well, it's going to be the emerging market countries who are really hurting from the lack of trade due to the pandemic. As far as seeing as this as an excuse to move to a completely digital currency, I don't see that, although that's kind of the narrative right now, is this is what the IMF is suggesting to the central bankers of the world, is we need to move down to a digital currency. And I've been thinking a lot about that, and I really don't subscribe to that view, because there's still too many people, not only in the United States, but around the world, that use paper and coin currency. I mean, as part of their daily life. For some people, that jobs are completely wrapped around being paid in these currencies. And a lot of Americans, since the great financial crisis, just don't trust the banks, and they don't even have bank accounts. So the whole idea that we can, go to some digital currency, make it an overnight switch, and everyone's going to say, hey, well, I think it's going to take a lot longer than people think. Now, does that mean that we can't start that process? And we know from the Fed that they are, and that it may be blockchain based or some other form. Well, absolutely, I see that. But the idea that we're going to just magically wake up and paper currency is going to be outlawed, and it's going to say go down to the bank and turn it in. Yeah, I don't see that happening right.
Yeah, I agree. It's not going to be an overnight change, and there will definitely be a transitioning period, where at least if that did happen, people would be able to turn in their coins to get some value out of that. And it's interesting that the pandemic has also caused a coin shortage in some areas, and people are also afraid to use bills, so they're trying to recommend debit and credit, and it just seems very timely that all of this is sort of happening at the same time. Wouldn't you agree?
I do. And I think all the pandemic did was just kind of wake up central bankers who are very reactive, that we know, proactive to the fact that, hey, what we're doing in the paper and coin is fine now, but it requires the economy to be moving. It requires a velocity of money to be higher. And the reality is you cannot respond quickly to the shocks to the system full of money that they could just move out into the economy. But with a digital currency, they could expand that to meet the needs of people who do need it, and then they could contract it back very easily. So I think this was a big eye opener for them, and hope it encourages central bankers to put a lot more time and effort into it than perhaps they have in the past.
Yeah, and speaking of digital currencies, Bitcoin, but also gold and silver as hedged assets have done really well throughout 2020. And a lot of investors have been recommending to have a diversified portfolio that isn't 100% in the equity market. What's your take on gold and silver and Bitcoin rising this year and the value that they have in a diversified portfolio?
Well, there's no doubt that we've seen gold and silver rise as an inflation hedge because people believe inflation is coming. And part of that is substantiated by the fact that real yields or inflation adjusted yields have been falling. Now, I think we're going to see real yields rise, and that's going to mainly be due to, I believe, the consumer price index is going to head a lot lower when we see a big rally in the dollar. As far as, say, Bitcoin being a hedge, that's I looked at it on chart many times, and sometimes it's a risk asset, sometimes it's a safe asset, sometimes it's an inflation sensitive asset, sometimes it's deflation sensitive. You really don't know. And I like to say that we'll learn a lot about Bitcoin and other cryptocurrencies when we actually see a real bear market. As far as using it as a hedge, sure. I mean, if someone feels comfortable using gold and silver and Bitcoin as a hedge, I would absolutely encourage that. But do keep in mind that if real yields rise, as I think they will, that they expect a pullback in both the metals and potentially in Bitcoin as well.
Yeah, good advice. And we're running out of time, Steven, but one last question is, what advice or suggestions would you have to people that are in America that aren't necessarily investors, but they may have started becoming interested in investing and preserving their wealth throughout 2020 now and are looking to learn more information?
Well, the best thing I can advise people, and it's true whether they're investing in the stock market, bond market, or the real estate market, or anything in general, is don't buy high. And so if you believe prices are high in the equity market, then the smartest thing you can do right now is just build up your cash and wait. And waiting is the hardest part that most investors have to do. But those who have made the most money and created the most wealth for themselves and their family are those who are patient and wait for the opportunities to come to them. They don't force the opportunity just because they have a little money in their pocket.
Definitely. That's great advice. Don't buy high, buy low, sell high. I like that. All right, Steven. If their viewers are looking to learn more information about your content and your work, what's the best way for them to follow along?
The easiest way to find me, Ashton, is at my website, stevenvanmetre.com. They can also find me on YouTube. Just put my name in the search engine, and you'll find that I do 3 macro shows a week and a chart show on the weekends. And of course, I'm on Twitter at Metre Steven. It's spelled a little different than it's pronounced.
Awesome. Thanks, Steven. I will leave those links in the description box below for the viewers as well. All the best moving forward, and let's follow up in the near future.
Great. Thanks, Ashton, and I appreciate you having me on your show, and I appreciate your viewers watching.